All right, thank you for joining the Cash is King panel. Welcome back to Earth. This morning we heard about artificial intelligence, strategy, and some very entertaining topics, and now we're going to get down to the basics and move back to cash. So welcome. My name is Jeff Dykstra. I'm a principal at KPMG, and I run KPMG's National Treasury practice. I primarily work with banks, but the banks that we work with are typically trying to figure out how you all would react to various stresses in the financial system. So it's really interesting to be on the other side of this with a panel of CFOs from very, very different industries. Just a little bit of background. Prior to KPMG, I was an expert witness in the Lehman Barclays matter and have spent about 12 years helping banks develop liquidity stress testing programs, contingency funding plans, resolution and recovery plans, really to help prepare for the types of events that we've seen during the last 4 years, a global pandemic, massive cash infusion into the economy, and then a banking crisis to top it all off. So we have a lot of interesting topics to work through with this group today, and really excited to hear the introductions of some of our panelists. So Jason, could you tell us a little bit about your company and your role?
Sure. So I work at Vendor. It's a basically software platform that allows companies to buy other softwares. Most of the industry, as you probably know, in technology, is not as transparent about what price other people are paying, what commercial terms they may have. It's usually a unique snowflake. So what we're trying to do is acquire everyone's tech stack, basically aggregate that and share that throughout our customer base to help people make better decisions. The other thing we do is for people that do sell on the sell side, sell technology, is we sort of allow them to distribute their software to our sort of like buying platform and make that as transparent as possible if they follow certain rules. So my background, so I'm in the VC-backed companies. So I would say that I focus, for this panel, I focus more on like the cash flow, which is like how the bucket, I would say, empties or fills, how quickly that's moving around. And then I also spend some time, obviously, making sure that where there is cash and the bucket is there, what we're doing with that, and really more on a conservative level. So love to hear from the other panelists on how they're doing more probably integrated and more sophisticated treasury. So thank you.
So thanks, Jeff and Jason, and great to be here and great to be speaking on this panel. So my name is Dustin Peterson. I work for Locus Robotics, which is an autonomous mobile robotics and software provider that helps automate fulfillment and distribution warehouses. So in distribution and fulfillment warehouses today, most of the work is done via people pushing carts up and down aisles, walking 12 to 15 miles a day. And what our AMR solution allows, so Autonomous Mobile Robot Solution allows, is for those people to be more efficient in terms of productivity. They can do 2 to 3x the number of picks, or with the reverse of picks, which are puts per hour. So it's really an automation tool that's helping a very growing area of the industry. My background is I've been both in subscription software as well as I spent about 10 years at Honeywell. And I think the unique aspect of Locus that's unique to the industry is we are a subscription model. So we call it RaaS, Robots as a Service. So it's akin to SaaS, except for we have obviously a physical piece of hardware, as well as for my benefit, the supply chain that comes with it and the complexity there. So it's great to be on this panel, and pass it over to you, Chris.
Thank you. How you doing? My name is Chris Caprio. As of a week and a half ago, I'm the CEO of Focus Technology. I was the CFO for 6.5 years, led a various investor group to buy out the then ownership. Focus is a outsourced IT. We're managed services, cybersecurity, hardware reseller in the tech space, based here in Boston. My background, been a CFO about 12 years at about 3 different companies, mostly in the services space, small middle market, M&A, and cash is certainly king, and we'll learn about that today.
All right, great. Thanks so much, Jeff, Jason, Dustin, and Chris. Happy to be here on the panel. My name's Kelly McDonald. Really exciting, companies that you're all working for. I work for a company that's a good old-fashioned commercial stage biotech company. Although we do manufacture and commercialize novel vaccines for infectious diseases, so these last couple of years have been really exciting for me in the industry. And, some of the things that we are a public company, we trade just under $2 billion in market cap. So some of the things that I'll look to bring to the panel and complement, my colleagues up here with, will be around equity capital markets transactions, including convertible debt, and then, how we manage a very risky portfolio management process where we're deploying capital to drive both near-term and long-term value to shareholders. So pleasure to be here, and thanks again for the opportunity.
Great. Well, thank you all. Kelly, maybe we can start with you. I'm really interested in the business model of biotech. You mentioned it's a very capital-intensive business where you probably have a longer research and development cycle that you need to invest in. How do you think about cash as you manage a portfolio of those types of investments?
Sure, thanks. So one of the things that we do at Dynavax really well is a very robust portfolio management process. And we look at assets from when they're in animals, so even before they get into humans. And we think about what's the commercial opportunity going to be even 9, 10, 11 years out if that candidate is successful. So I think for us, taking a look at not only the NPVs of the asset opportunity, thinking about things from a commercial viability perspective, and considering all of the costs that will take to get from point A to point B if successful. That's certainly one element of it. We're also looking at discrete investments in the next 1 year, 3 years, and 5 years, and that's something that we hold our teams accountable to, and we have very clear stage gates identified. So those are some of the tangible things that we put into place on the finance team to really operationalize some of the decision making that helps support driving value to the business and helps support driving our decision making process.
Great. And Chris, your business model is very different in terms of the cycle, how you manage inventory. How do you approach your decisions around how much cash to hold?
Yeah, we got lucky. The industry moved to drop ship, so we've pretty much eliminated needs from an inventory perspective. But obviously, our people are our driver of costs for the most part. We deal with large, middle market enterprise customers who are putting more and more pressure on payment terms. They actually want to hoard cash more than they did a few years ago when, they were getting a half a point maybe on float. We got paid more timely. Now that they're getting 4 or 5% or more, it tends to be a struggle to pull cash even out of cash-rich companies. So we're really managing that tightly and trying to figure out what we can do to incent some of these customers to pay us sooner. We're a small middle market company, and 1 or 2 late vendors, and we're kind of in a bind. So definitely paying more attention to that than we have in the past.
Great. How has the current market impacted your business, Dustin?
Yeah, so obviously, so we're a venture-backed company, similar to Jason. We've raised over $400 million of primary capital to date. And we have 2 main, we'll call it uses of cash. One is the people that make everything happen. And the second piece is inventory. So one of the things that we've become, as interest rates have risen, as the cost of capital has become higher, we've been much more focused on running leaner, just in terms of on the inventory side. So really managing our work with our contract manufacturers to ensure that we have closer to, we're not a just-in-time shop, but our build-to-stock model is now such that we carry a lot less safety stock, and we just manage that a lot tighter because, frankly, the way our model works is we have to build robots in advance of obviously selling them and allowing customers to subscribe to them. So there's as we grow quickly, we have a natural cash burn, and when customers pay us their first annual advance payment, we kind of cover that cost of the inventory, but there is a gap there, and it's something that because we only have 2 SKUs, it makes it a little bit easier because we don't have supply chain complexity around different piece parts and components, but it is something that we've taken a much more active, or I've taken personally, and my team's taken a much more active view in terms of managing with our procurement team and with our operations team to ensure that we can be smart, because as I learned early in my career, every dollar of inventory is a dollar of cash that's sitting on the shelf, not doing anything for you.
Great. And Jason, in your business model, you often have to think about raising cash and when the next cash raise is. How do you go about that process? How do you think through the process of how much, when, and how and who?
Yeah. So just for background as well, and so Vendor is a SaaS subscription model. Prior to that was I took DraftKings from product market fit all the way through public. So over, let's say, the last decade, there's been a lot of capital that's been raised. Most of the time is mapping out over really a 1 to 3 year period where you believe you're going to hit certain milestones that what is currently within the market that said you'd be able to raise at a specific price that you'd say, I would be feeling comfortable with that dilution. You obviously check with your various investor community to see if and justify, like, if we hit these certain milestones within certain ranges, then the capital will be there to refill, like I was talking about, the bucket of cash. Obviously, the last year or so has substantially changed what is required to sort of hit in certain metrics to justify, continuous investment. So what we're seeing both at Vendor, but also what we do is we help like 3 to 4 billion of technology companies like transact technology between themselves. Everyone's really pushing out their expenses, making sure that they're trying to get to profitability or get to a very mild sort of cash burn. And what they're obviously giving up is growth to do that because of the sort of economic environment where raising capital might not be there. And there's two major trends that we're seeing that is happening is like the AI investment, and people are worried about, or VCs are worried about, like, what is their framework for invest? Does this business model actually have legs 3 to 5 years out with generational AI coming up? And the second piece is that is your return actually there? Because with interest rates being, you could basically have a liquidity, government-backed or security at 5%, whereas PE models are looking at, trying to get a 12% return, and VC models are trying to get maybe above a 20% return, but just holding the cash is at 5%. So it's the risk tolerance of saying I'm going to invest. What's your risk tolerance is definitely not 2x and get the return. It's probably like a 10x risk tolerance that's happening if you put capital to work. You're only really getting 2x the return off of that. So it's changed the dynamic quite substantially. Luckily, Vendor has enough cash to go forward, so we're not doing it in that world at this moment.
Great. So we have a mix of kind of public and private business models here. I want to move on to one of the items that the CFO of Johnson & Johnson brought up around the importance of the CFO as a communicator. So when you think about the stakeholders that you communicate with, whether they be public investors, private investors, the board, what are some of the issues that come top of mind when you're thinking about how to communicate why and how you're managing your cash flow? Kelly, maybe you could weigh in on that with some of your, as a public company. I think it's particularly interesting.
Sure. So we spend a lot of time really working with our investors and also our employees and board, of course, to help everybody understand our capital allocation strategy. For us, as a company with commercial product, we are held accountable to have a path to profitability, which is unique compared to a lot of companies in our industry that are R&D stage and have the ability to continue to invest in their pipelines with the expectation that they'll have to go back out to the equity capital markets to raise based on the next catalyst or the next value inflection. We, on the other hand, do have to have a clear path to profitability and free cash flow, and then with that backdrop in mind, of course, our investors are very interested in what's our highest and best use of each dollar that we spend, and how do we deploy to continue to maximize top line growth CAGR, as well as they want to make sure that we have a robust corporate development process and are evaluating assets inorganically. And then, of course, from a treasury management perspective, a lot of focus around diversification of how we're managing the cash on the balance sheet and our asset portfolio. I think that's come under a lot more scrutiny than in the last year or so, compared to the few years before that, when cash was much less expensive and much easier to access, at least in our industry.
Great.
Yeah, I want to focus on internal, something that the SVB situation brought up to me that I didn't realize. So I've been controller, CFO for a number of years, private, public, venture-backed, private equity-backed. I think as CFOs, for the most part, we're really good at communicating up. the board, management, outside investors. But the SVB situation made me realize, probably for the first time in 20 years, the need for internal communication. We were not an SVB customer, and it was sitting there on Saturday or Sunday, and I'm talking with my management team, and they're like, you got to go tell employees that we're fine. We have, we're at no risk or no short-term risk of this. And I think with all the interest rate changing environments, inflation, our employees, I think, are more educated, and they want to know and learn what are you guys doing with their money, our money as a company. So I think we've spent a lot of time and efforts over the last 6 months, communicating that. Obviously, I just explained, we raised capital a week and a half ago. To think we can just say, oh, there's a CEO change and no big deal. Like, no, they want to know what happened. We took on debt. They want to know that. I want to be open about that. I don't have to give them the terms, but I just think as CFOs, I'll say it again, we were always good, and we still are, about, explaining cash up, and I think we need to spend more time explaining cash down to our employees and what we're doing, and the runway, if you're, a SaaS private equity backed, or, if you're making investments, what your return goals are, things like that, I think are important to explain.
Yeah, in our situation, obviously, with interest rates rising, with capital becoming more expensive, the biggest thing, just maybe back to Kelly's point on capital allocation, is growth versus profitability. It's a bit of a continuum, and where do you want to target kind of on that continuum? And I think that's something that's been important to me personally, is to make sure there's good alignment with the board, also the management team, and as well as the rest of the company. So those are three different, effectively, audiences that you want to make sure are aligned in terms of the strategy as well as the execution of that strategy. So in the last year, we've definitely shifted. We've become more scrutinizing that extra dollar of investment in go-to-market functions or what have you, because profitability has become more, we'll call it more of an important thing than it was 2 years ago. So it's an area that I felt it's been best to almost over-communicate with the different parties, just to ensure that there's good alignment. And then with my finance team specifically, especially the FP&A team, is working with the different business leaders to ensure that we're all talking the same message, we all are speaking the same language, and that there's good alignment, that this is actually best for the company today, even though that may not have been exactly the same strategy we would have had a year or two ago. And to Chris's point on the SVB topic, we were an SVB client. We still are an SVB for Citizens client, but what it did is it caused, we'll call it, the need for diversification in terms of bank accounts and some very basic things that most companies have in place. We did fortunately have some of that in place, so we weren't severely impacted, but it made it for a very interesting 3 or 4 days between when SVB went under and when the Fed backstopped SVB on Sunday. But what I will say is that we now have an investment policy. We have certain, we'll call it belt and suspenders type instruments in place, such that if a situation were to arise again, we'd be in a much more comfortable position. We were fortunate not to be very affected, but there was a lot of focus on ensuring that we had what we need if there was another, we'll call it, unique situation that came up.
The only thing I would add, because capital allocation is very important, where that goes. The communication between the main stakeholders about what sort of growth or sort of returns that are being expected, or sort of at least would be appreciated from the investor community, given that you potentially want to raise capital in the future. Like, one of the things that we're doing at Vendor is going deeper into the PDE organization. So most of the time you can see returns relatively quickly on the sales and marketing side as you're sort of pushing. But now that with a lot of scrutiny, particularly with the return on investment in all areas, is what is actually the development team doing? How much are they actually, taking down the technology debt? How much are they actually generating potential opportunity for new revenue streams? So that's been an area where we've spent a lot more time. We're I would say over the last 5 to 7 years, in other companies, I think they've just kind of said, like, let's continue to hire as many engineers as possible and let them sort of go and make sure that we're hitting our revenue numbers. Now it's more about the aspect of the return on investment that's being deployed in that area.
Great. Well, Chris, you really piqued my interest when you started talking about Silicon Valley, and I know that the two of you, that Dustin and Chris, were both Silicon Valley clients. Kelly and Jason, were you working with Silicon Valley as well? So we have four banks or 4 companies that were all working. I'm curious in the audience, how many of you had relationships with Silicon Valley Bank? Oh my goodness. So a bank that most people probably wouldn't have thought was as central to the financial system, and we have significant coverage. So what can you tell us about that week, which hopefully will be a distant memory at some point, but I'm sure is still pretty fresh right now in 2023. What are some of the phone calls that you received? What are some of the phone calls that you made? And how prepared did you feel that you were then and now for managing this fairly unanticipated but significant cash event? Dustin, do you want to get started?
Yeah, maybe I'll start. So, like I mentioned, we still are a Silicon Valley Bank client. We have a line of credit with them. They was great partners throughout. And one of that Thursday, I don't think I've received a phone call from every single board member within the matter of about 2 to 3 hours independently, and that happened that day, which is maybe that'll be the only time that ever happens. I certainly hope so.
Communication.
So there's a lot of communication, and that even I was working directly with our person who coordinates wires to try to get money out, and the website kept locking up. So it was a very interesting day because you're talking to board members to trying to figure out why a website isn't working and why we can't wire capital. But what we ended up doing, just to mitigate, is we opened very uncomfortable position of having to tell my controller to email every single one of our clients telling them not to pay us, right? Which is because they were our operating account. That's where we received all of our deposits. So that was interesting. And by the way, we don't have a backup bank account, so just hold tight until we get back to you whenever we get one set up. So it was an interesting time. That weekend, I worked to get an account set up with Chase. So we had an operating account. It was, Chase, we don't need everything. We just need an operating account, and we need it today. I know Chase had all hands on deck opening accounts that weekend, and it actually worked out very well because they've got a good international presence. We're expanding internationally, so in the long run, this may have been the best thing anyway. But it was a very harrowing week, and I think the other piece just that we had a fair amount of capital in our money market account, and it was a SVB cash sweep account because we just raised a $125 million round in November. So it was 4 months post-round, so every board member was very interested in, is that money backed by SVB? Can we actually get it? And thankfully, about a year and a half earlier, I'd done a bit of research and ensured that the securities were actually in our name versus SVB's name. So SVB had a different product where you could earn a slightly higher return, but they were they were in SVB's name. So that was an area as well that it felt very good to be prepared to say at least I had an answer to that, and we were not going to lose the money. Maybe we couldn't access it for a period of time, but the capital was still there and still in Treasury bills effectively in Locus's name. So interesting week, and hopefully we don't have to go through that again.
Yeah, also not my favorite project of my career. Similar experience to Dustin with all the board calls, as I'm sure many of you in the audience experienced as well. But I think one of the major learnings and takeaways from us that we were able to operationalize very quickly thereafter actually was around fraud protections. So, Forgate is something we were actually kind of chatting about in the hallway, but fortunately, we didn't hear about a lot of fraud, but I think this scenario was sort of fraught with fraud risk, and a couple of our board members brought that to the forefront in their phone calls to me, sort of late Thursday night. So what we ended up doing and what we ended up kind of sort of making a policy thereafter is, being on the phone with these banks as we're transferring large sums of money. That's probably a best practice that hopefully everybody in this room is already partaking in. But for us, it was an unfortunate reminder of the need to sort of be really strict about some of these things from a fraud risk perspective.
Yeah, we weren't heavily impacted. We did analysis around potential customers that would have owed us money that coming week, which is important. But I think as a CFO, you go back to COVID, in that March timeframe, certainly that weekend, I was around in 08, 01. I mean, it seems like we get paid for the disasters that happen around us, and it just completely reiterates to me, and I'm sure to many of you, contingency planning. Like, you can't just wait for the contingency to happen and say, oh, we should have had a contingency plan for that. It's really now ingrained in what we do, looking at top 5 risks, top 6, 10 risks, whatever how big your team is and how much risk you have is, for you to investigate, but really understanding, macro impacts, micro impacts, internal, external, and really just continuing to do that. And that's, I guess, why we're the CFOs. That's our job, and I think it's shown to others, those couple times recently, but I think it's truly the board knows and the management team knows that they expect you to be doing that every day, and it just needs to continue along.
For us, we had a small impact with SVB, but it was sort of like 3 systematic things that we had to sort of deal with right away. One was what was going to happen with that amount of money in SVB. Luckily, it wasn't enough to sort of worry about per se in the moment, but quickly the sort of emergency sort of shifted to First Republic Bank. That's where our operating account was. That's also, we had rippling, so that was also making sure we can pay our employees. So we had that question of, well, wait a minute, if we're going to move that, then we would have to reset up and integrate with the payroll provider. And so we ended up doing that because we just didn't know at that point in time with SVP what was going on with First Republic. So we sort of cleared the deck, moved to some of the top banks, one of them being Wells Fargo, most of the weekend, and you sort of really know the quality of team that you sort of put together, and they really stepped up to the moment. So today what Vendor does is it has 3 major banks that we have sort of our cash in. We do a daily sweep. The only things that are sitting there that are at risk is if anyone paid us that particular day in the evening, and most of everything gets invested, and get a 5.25 point, which is sort of pretty meaningful at this point. So that's how we manage that emergency. And so.
Great. Contingency planning is something that you brought up, Chris. This is something that in the regulated banking sphere is very structured in terms of the development of an annual contingency plan with war room exercises, embedded stress tests, waterfalls, communication plans, playbooks. I'm curious how much you have formalized that process since. Is contingency planning an idea right now that is kind of in recent memory, or is this starting to become a process where there's a document, a tool, a framework that you consistently can follow in the future? Anyone really?
Yeah, I mean, for us, it kind of started probably 4 or 5 years ago at Focus, so we continue to do it. Look at our top risks and understand, our top 5 or 10 customer risks. We monitor them if they're public companies. Certainly, what we can scrape off if they're private companies and large, and really, focus on that. What is the impact of those customers if something happens? But yes, it's been ingrained in us for a few years since we started doing M&A, and cash was less at our fingertips than and our debt was there. And we continue to do that for sure.
Just building on that, similarly here, we have an enterprise risk management program as a public company where, we report out to the audit committee on that program and the top 5, top 10 risks and any meaningful changes. I would say Treasury has become sort of elevated in that risk paradigm as we think about overall enterprise management. So, it's something that we pay a lot of close attention to, and certainly as we think about diversifying our Treasury portfolio and asset managers, something that gets a lot of attention.
Yeah, and we've paid attention to it in the past. We pay a little bit more attention to it now, but I'd say our real, because we're a company similar to, like I mentioned, similar to Jason's, it's the bucket and how fast is that bucket emptying. There's much more focus on that aspect, just given the environment and ensuring that every board meeting, obviously we talk about cash, and we've talked about cash before, but now we talk about cash more. And it's just a matter of life these days. And I think that's where more of the focus has shifted, rather than kind of once we got we'll call it the diversified strategy, and we have an enterprise risk management program and that sort of thing in place already. So it wasn't so much anything new on that front, but it's more how do we maintain and hold the cash we have and use it appropriately.
The things that I've seen is that when I look at Series A companies, Series C, or Series, we got into like E or F, in 2021 or so. As we sort of scaled companies, most of the time you're thinking about really, as you're getting ready to go public, putting in a really good treasury department. Now it just seems like if you're starting a company, once you raise a relatively larger round, you needing to think about that. So as a CFO, you need to have that treasury toolkit. Sometimes you can't afford yet a treasury department or a treasurer. So you're just really being abreast of like what you need to be doing to protect yourself. So I just see that what I saw was much earlier. A lot of our companies that we sell to the SMB market they didn't have a CFO, so they were talking to me a lot about how to set up just to make sure they were all set before they could afford a CFO or before they could afford a treasurer. So I think it has changed, particularly this last 6 months, has changed the dynamic that treasury is going to be much more important much earlier than it ever been in a company's life cycle.
Jason, how many metrics do you look at as a CFO? And when you think about cash, I guess Siri liked that too.
Yeah, there's a lot.
I'm curious to see what she comes back with here. But I'm curious, out of those metrics, what are the most important metrics in terms of understanding your cash position, your cash needs?
Yeah. So specifically around the cash needs, as you talked about, so we try to forecast the business, the cash movements on a daily and weekly basis, and we look at various tolerances that are doing that. And fun things about putting everything in Snowflake, and you can use AI tooling to understand like what your predictability looks like. So that's our biggest component. So what's coming in and what's coming out, just as what you're talking about with the bucket, and then trying to better understand, really just trying to keep as much cash into a very secured area at this stage, and only holding as much as what you need to make sure that you're paying the payables and you're paying employees. So that's really the focus. I would say on a much more like broader level with the business, we're trying to look at investment, if cash is being deployed, whether that's in people or that's in marketing or that's in sales, like when do I think we're going to get that cash, that specific cash back? When are we going to make that money? I'm more on the operating side of the house.
And do you have a key metric or
like
horizon that you like to look at when you're thinking about that?
Yeah, so like I said, there's a day, week, and then there's it's usually like 6 months, 12 months, and then a couple years. And why? And you do things. One is like the very tactical management within that very short period of time, which is really like a quick ratio or current ratio. And then the more longer term that we're looking at, it's really about your burn multiple has been sort of like a key metric that we're looking at when you're looking at an ARR base that's growing, and then how much that's sort of like how much cash you need to burn to sort of add additional ARR to the base. And that's a nice metric that allows us to figure out if we're sort of in a ballpark. If we could raise tomorrow, you could sell tomorrow. That's always been a key aspect. I would say the other addition is like rule of 40 is like come back in waves, or even here sometimes rule of 60. Great if you can do it, but we're sort of like more in that rule of 40 premise at this stage.
Yep. Yeah. And we're similar just in terms of obviously cash is more important, more valuable. I've said this already, but I think in terms of specific metrics, like traditional metrics like DSO, it's something that we didn't pay so much attention to in the past. Now we're looking at it, and it's part of every board package. And it's just ensuring that we've got better process around both receivables as well as payables to we'll call it maximize our cash position. But in general, I think the main things that we look at are just how to Jason's point as well, is how predictable is our cash forecasting, and can we improve it? How can we be better looking 6-8 quarters out versus just having that really small tolerance around the next quarter. And that cash forecast is driven by, we'll call it traditional SaaS metrics, such as your CAC. So how much are you spending on sales and marketing relative to how much you're actually bringing in terms of new bookings? Your burn multiple or capital consumption ratio. How much are you burning on an aggregate relative to the bookings you're bringing in? So they all fit together, and you just want to make sure that you've modeled them and that everybody's on board with the assumptions around that modeling, and that you're actually operating and executing against it and refining it as you go.
Yeah, I mean, we're fortunate from a perspective of we're cash flow positive, we're, have positive EBITDA. I guess maybe I'm a little old school here, is I have a weekly call with my collections manager and, top 10 customers that are problems, and it's kind of, she's been working for me for almost 6 years, so she's kind of, it's not necessarily the 6 highest, balances or whatever. It's just, problems with getting back to us and things that first time, I think one of the most important thing is, has this customer ever paid us before? Sometimes it's very simple as you're not set up correctly in their system or for whatever reason. So, certainly focusing a lot on that. And then the other side, because we're in a debt position, covenant calculations, just weekly, monthly. I mean, obviously it's coming from cash flow, don't get me wrong, but as far as what I'm looking at, I'm just looking at, in relation to that, what is our covenant calculations projected out 1 quarter, 1 year, based on our forecast, based on our budget, and making sure if I need to make a call to the bank, I'm doing it well ahead of time versus after the fact.
Yeah, it's great to have such a variety of organizations up here on the panel. I think one of the things that, as a more mature public organization that is profitable, we spend a lot of time looking at cost of capital. Because we do have the opportunity and ability to access equity capital markets, as well as hopefully straight debt in the near future. So thinking about how much our cost of capital is on a quarterly and semi-annual basis is really important for us, especially as we think about deploying our cash balance to different assets and different investment opportunities. And that as we think about those different investment opportunities, certainly looking at IRR, money over money, payback period, those are the kinds of things that we spend the most time really scrutinizing and making sure that our organic portfolio is also going to stand up to any inorganic decisions that we make, or vice versa. So we're it kind of gets to one of the points that we heard earlier this morning around an investment in biotech in particular. It doesn't matter if it's developed in your own lab or in another lab. If it's a good investment, we want to make sure that we're positioning ourselves to be able to deploy capital to that investment.
Great. Kelly, sticking with you, I think you mentioned that you had done some M&A in the past, and I'm just curious, what were some of the things that stood out to you in terms of the planning process for how to plan for the cash to close a deal, how to position yourself for various opportunities that might come up along the way?
Sure, M&A is hard. It's really tough, and of course there are a lot of ways to finance a deal. You can use stock, you can use equity, you can use stock. You could raise more money, or you can use a combination of debt and different instruments, including convertible debt or structured debt. There's all kinds of really creative solutions. I think one of the things that I've had the fortune of experiencing in a myriad of transaction types is going through that scenario planning, that sort of tabletop exercise, thinking about the variety of options at your fingertips, working with different banking advisors, different banking partners to really understand what's available. And it can change year to year. It can even change quarter to quarter if you think about the convertible debt market, for example, which has kind of come up and down in massive waves just over the course of the last 12 to 16 months. So yeah, I just encourage everybody to make sure that you're being creative about how you're thinking about financing transactions, and almost don't take no for an answer. Go, kind of keep getting advice, because different banks and different advisors have different abilities to take on risk and support transactions.
Yeah, I mean, M&A starts today, if you're even thinking about it, talking with banks, understand where it's coming from. One thing I realized over the last few months is mezz debt isn't as expensive as it used to be. Their rates have kind of stayed flat in the 11, 12 range, while banks are probably up over 8, and depending on who you talk to, 7, 8 or more. So, really understanding the front end aspect of it, because obviously sellers want as much upfront as you can. But, we've tried to push back in the past on earnouts, on deferred notes, things like that. So understanding, at the end of the day, you have an IRR calculation that you need to bring home, and it's getting your bank, potentially mezz debt, the sellers, all, positioned to make sure, all right, I can't put my company in a tough spot, even if I really like this acquisition. You got to have, this is all you're getting down, this is how many years an earnout's going to be, this is your cap on the earnout. Really thinking about that now, so when you walk in and find a company you like, you don't have to say, all right, wait a minute, give me a week to figure out how much money I can pay you. Be ready and understand that, and target companies that you can afford. If you have that conversation and the multiples are 8 times and you can't afford that, move along. But I think planning for that up front is extremely important. Get it across your board, CEO, whoever, is going to make that decision, agree on what you're going to do, and then go do it.
And maybe a slightly different take is, obviously, to Chris and Kelly's point, have your strategy, but also just recognize that in today's environment, there's going to be a lot of consolidation across a number of industries, just given the challenges in raising capital. So what we've done is we've prepared ourselves and determined where we want to focus from an M&A standpoint, because there's a lot of noise and a lot of inbound coming in, and it's always interesting to take a look and see what's out there. But you have to be focused on what you want to do rather than chasing something that could be diverged from your core competency, your primary strategy. So we've taken we've sat back and taken a pretty pragmatic view of the market, and it seems like each day, month that passes, there's more consultants that are calling in with X and Y company that is looking to dual track or whatever else. And I think that's something that I'm sure you all see as well, and it's just something to be aware of. There could be good opportunities on the table, just given the environment today.
I would agree with that. I mean, what we're seeing is a lot of companies are starting to. I think the choice you have is where does your investment thesis, what do you want to build or buy, and there's a lot of companies coming up that are looking to sell now, because they're saying, okay, 12 months from now I probably can't raise capital. So we're starting to see quite a bit of that. I think the other aspects is, if you do have a lot of cash, like they're thinking that they would love to be acquired by you, because there'd be a cash component as well. And I think that's obviously something that we're looking to preserve quite a bit. The other piece is that what we're seeing in the software space is that prior to vendor getting on, when I first joined, what we saw was a lot of companies sort of accelerating their growth in their niche that they sort of develop in their software niche. So they sort of, I have that market, I'm going to go forward. What we're seeing is if someone was adjacent to them, they're sort of building very quickly what that company already did, and then they're trying to obviously take that sort of wallet share from that customer. So it looks like more of a horizontal play that a lot of the softwares are starting to take, and that's putting a lot of pressure as well as on M&A. How quickly can you do that? Is it better to acquire and build in that technology and try to offer overall platform suites? So I think that is going to be an interesting piece to the consolidation market, but my advice would be don't put cash on the table just yet. I'd wait.
Good advice. Well, let's open it up to the floor for questions. Do we have a couple of microphones around the room? Okay, great. Are there any questions?
Thanks to you all for a really great conversation this morning. It's been great to see your diversified views and backgrounds. A question for you, considering that your focus is on cash and all the things you've mentioned, what are some of the smart ways you've seen incentive or bonus plans structured in your companies to ensure the focus is on cash?
I'll start. Maybe one specific example is just sales incentive plans. We are a company in which we sales folks sign contracts and sign agreements, multi-year agreements, but there's a 3 to 6 month lag between when the agreement's signed and when we actually have deployed the robots. So we've shifted a bit just in terms of the percentage we pay up front relative to when we can first invoice, and just made that more in alignment with how the company thinks about things. We still want to make sure sales folks are motivated, but at the same point, we have to do what's best for the company, and we don't want to be, we'll call it covering that float.
Yeah, I mean, we pay 30 to 45 days after, so most of our payment terms are in that range. So, if you're March 31st commission statement, you're getting paid, depending on if you're a direct sales rep or indirect, either April 30th or May 15th. So, tying it a lot to when we expect that cash to come in.
For us, it's really, we also have a sales incentive plan. We use equity pretty generously as a biotech company for compensation. And I think for us, it's really sort of tone at the top and making sure that folks understand that, how they deploy their own capital and their own budgets and how they're held accountable to executing to their budgets is really important to every single senior leader and every single leader within the organization. So we really try to just, have that discipline sort of instilled throughout the org and all of our employees.
So the two aspects of like compensation planning that we sort of talk about. One is overall, when you're a startup, is where do you want to sort of have your cash compensation? What percentile do you want to pay at? We've selected to kind of be a little bit less than sort of, I would say, the high end of the market. The philosophy being that, look, at the end of the day, if we're putting cash in your pocket versus into the business, then that's sort of like diluting potentially the equity aspect over time. So that's an agreement having with the executive team and sort of making sure that, through the interview and recruiting process, that everyone sort of bought into that aspect. That seems to usually takes like 10 or 15% of your cost structure out if you're sort of bought into that, and then you lean into equity. The second piece that we've sort of made an adjustment for once cash became a little bit more scrutinized is we also have a sales team. Everyone wanted stretched out payment terms, and so we sort of adjusted our sales compensation where they were able to retire a little bit more quota to have more scrutinized or like better payment terms and more lax payment terms. We didn't want to slow down the sales because we do want to be an aggregator of software purchasing and wanted to continue that growth, but definitely was able to incentivize the sales team. And once you sort of incentivize them, the payment terms weren't really the actual issue. So then they sort of moved on from that. I mean, there's a lot of things that companies can do, but I think on the compensation side, that's like our biggest thing in SaaS.
Great.
Thank you. Nina Trentman from Bloomberg. One question with regards to cash and cash management in this current environment. How do you allocate free cash that the business is generating? Are you putting that into money market funds? Are you leaving it in bank accounts following the SVB experience? And also, how do you think about investments in other companies' corporate debt, as in bonds, versus U.S. Treasuries?
I can kick us off on that one. We have a pretty sophisticated treasury and asset management policy and process, so we really make sure we're scrutinizing first how much liquidity we need at any given time and how much cash on hand we need to execute the operations of our business. And then as we think about specific instruments, we actually have a process every quarter where we're reviewing with two different asset managers and sort of comparing and contrasting different expert opinions on where we can safely hold our capital while still maximizing the return on that capital from a yield perspective. So we end up right now in a lot of treasuries because of the inverted yield curve, and that's worked really well for us because it's given us both the liquidity and the benefit of yield. That won't always be the case, of course, but for right now, that's sort of where we are. We take a pretty conservative approach. We're not an investment bank, so we're not here to take a lot of risk with our capital.
I'm just trying to pay down debt, so.
Yeah, and we manage ours through a cash sweep account, so we just keep minimal. It sweeps every night and sweeps into a T-bill similar to Kelly. I mean, 4.25% is not bad. So our 5.25% is not, as an interest rate, is not bad, and that's been our approach. We've looked at doing certain laddering and such, and the incremental, we'll call it risk in having money locked up if we need it for some reason, even if it's a remote reason, it just isn't worth it at this point in where we're at in terms of our stage.
I think we're taking the same approach with Dustin. I mean, that's pretty much how it would work out. Yeah. It's just not worth the risk, the delta between the two interest rates at this point.
Great. Good question.
Hi. So I know there were some comments before about internal communications, especially in a changing environment as we have today. So I have two questions. How do you motivate employees during an economic downturn such as this, right? As companies are having to raise more expensive debt, cash is tighter, travel and all of those things, sort of professional development gets tight. Especially, managing a finance team, we see the money going in and out, and so we're always constantly, trying to keep them motivated. It's always been a challenge for us. And then also, in terms of just internal communication, what do you think the CFO's role is in that? Because I know, when a CFO comes out and talks to the rest of the company about money, it can seem very intimidating to other parts of the organization. So just wanted to get your take on
I'll take your latter one first. I mean, I think, I can't speak for every company, but typically the CFO is a trusted advisor internally. So, if just be open and honest with your employees. I think be transparent with what's going on, what your opinion or what your take of like COVID or SVB or whatever it might be with them. But I think, you have to talk with them, and I think they're looking to the CFO, not the CEO in times like that. As far as internal communication and motivating, it's, even though it's 2023, you got to have fun. I mean, you can't, regardless of the finance department, accounting department, sales team, I mean, you got to have an enjoyable place to work and understand with, as far as internally at Focus, we still have remote work. We don't require our employees to come in the office at all. We're trying to get together with them on a quarterly basis. So we're just trying to make it fun where, salary isn't number one. For us, we're trying to make it 4, career development, career growth, other aspects that make it fun and exciting to come to work at Focus versus, I just want the top dollar. So.
Yeah, and for us, just personally with Locus, we've been in the fortunate position of still growing quite quickly in this environment. So the focus in terms of communication to employees is around the fact that we're actually further distancing ourselves from the competition, and because we're just better positioned and we're executing fairly well. So I think that's a motivating factor in itself. If you've got a company that's doing well, even if you're not doing as well as you'd planned or you're off plan or whatever else, you have to really look at it relative to the broader market. So that's point one. I think the second point is just I took a class many years ago on crisis communications, and every once in a while you have to write one of those emails where you usually have time to prepare for it. And with the SVB crisis, it was all about getting good, to Chris's point, good communication out very, very quickly to ensure that the broader employee base had confidence that the company would continue on, that they get paid on time, and that's something that you don't plan for. But I think that was my experience as the CFO is doing that helped, we'll call it, alleviate some of maybe the unnecessary potential worry and chatter amongst our 500 or so employees. And it also set up for when we had I think we had a town hall like 2 or 3 weeks later than that. I've never received so many questions during a town hall, but I can only imagine the volume if that communication wouldn't have gone out, and if we weren't between the CEO and myself communicating pretty consistently as to what our approach and strategy were, and just to make sure everybody felt comfortable and could just act as business as usual on whatever they were doing.
Being a private company, we're able to put in a quarterly review where I'm leading it with the functional leaders. So what we did was, it's a very turbulent time. There's a lot of things moving around, and plus what Vendor did was move from a managed service to more software predominant, and then it's going to move to second transition is more data exchange related sort of aspects of its business. Those revenue models will change. And so now we have revenue that sometimes looks like it's down, and then some other times it's up, and then we're also unfortunately letting go of some employees in certain areas of the departments while we're funding others. So what we did was on a quarterly basis, we basically just, the department heads and we have generally a conversation about what metrics I'm looking at, holding them accountable to what metrics they're looking at. And that's been really helpful over the last couple quarters as they're going through and finishing quarters, and what does that quarterly result mean? How is the department lead thinking about it? How I'm thinking about it? And that sort of has built trust with the employee base to some degree, which is okay, now they're being fully transparent. The next step was all right, you just showed me 100 metrics. What does this all mean? And then sort of there's a final thought aspect at the end. So that's been a really effective way to build trust and just say, this is our core principles, this is what we're going for, and the employee base has been leaning into that.
Yeah, those are great responses, and they really highlight the importance of the CFO communicating regularly with the employees, and all of the stakeholders are involved, and to not always be the bad news bears, so to speak. All right, I think we have time for 1 or 2 more questions.
This is Ayaz Qazi with Artisan. Great panel, guys. Great perspective from all of you, different stages. So I'm going to go back to the topic with the things that we've heard on the panel, that cash is still king. What, given the SVB failure, given the diversification, and the more mature companies already knew that, what tech stack are you putting in place to answer three basic questions. What's my cash visibility right now at 3:01 in AM in the night? Anytime I want to look at it, what's my cash position across all my countries, across all my, and then that's many questions under that, right? Across multiple entities, et cetera, all that. What's the inflows, outflows, all of that fun stuff comes up to one question: what's my cash position right now? The second is, how do I make this better? How can I reduce the manual work and all the errors, so reduce the risk from all the errors, mostly from manual processes, spreadsheets, all of that fun stuff. Not because spreadsheets are bad, but the process that does the data collection for the spreadsheets can be messed up. And the third is, okay, now that I know everything that I know, then I've connected everything, how can I improve my cash position, maximize my cash flow, cash conversion cycle, whatever you're operating on. So three questions, and how do you answer that with a new tech stack? Because
Great.
the old guys won't do it for you. I'm ex-SAP, ex-Google. I can go into it, but that's, so sort of want to put it out. Because each of you will have it at a different stage and will have a different answer. Love to hear it.
So moment of truth, is it Excel, is it Snowflake, is it an advanced cash management system?
I can take this, I'll take this second question, which feels like a little bit of a cop-out, but I'll let these guys speak to those more elevated software solutions. So the second one was really on automation, and one of the things that, we did that I personally think is a little forward-leaning is, we identified the folks on our accounting and finance teams that are very process-oriented, so equity administration, payroll administration, treasury management, and even our insurance and tax support. These folks happen to be very process-oriented, and none of them are actually accountants or finance experts. So what we did was we put together a finance kind of support services team and have effectively tasked that organization with looking for opportunities, sort of that quote-unquote low-hanging fruit to automate, to look for ways to streamline our treasury processes, all of the manual, sort of repetitive process, and working really closely with IT to do that. That doesn't answer your question one or two, but hopefully that's helpful as we're all thinking about how to potentially reorganize our organizations and maximize the talent in our current finance footprint.
Yeah, I mean, I want to let these guys talk too. I'll just say real simply, I actually meet with my controller every Monday, and we understand why we missed or why we made last week's cash forecast. So we're just trying to get better by saying, were we off? Were we on? We have a multiple small percentage to be off by. But if we were materially off from what we thought we would have on Friday, why? And really just trying to understand that and get better at that.
Yeah, I mean, it's the same for us. We don't look at it weekly, we look monthly, but it's just having a good process in place and good linkage between accounting and myself so that there's adequate reporting. We don't have we'll call it a master tech stack that directs traffic or gives us all the KPIs today, maybe something in the future, but the process right now I'd say is adequate and working. Could it be improved? Probably, but I don't know the relative value versus the potential loss in flexibility.
I'd just say, I can take more of the tech stack maybe aspect of it then, because I would agree with everything that's stated there. So we're, and I can talk maybe a little bit more about how the market, in general, from a CFO perspective, there isn't a suite that we can go to and say, like, that's the one purchase that it does it all for us and it all integrates really, really well. So we sort of have to take various systems and sort of like ensure that they're integrated, and we sort of have great people that do process. So what I found really, really useful is the last couple of companies definitely have a Snowflake instance and really pushing everything in there, and then we're pulling it back out, and I get to see what's going on. And usually I'm linked to Tableau, which is mostly a self-service. That's there. Now, the aspects of building it, so we've implemented Brax, which is a nice system that allows you to swipe a credit card, make sure you can see things. Then we have Carter, that's more on the equity side. Then you're sort of rolling it. We were on QuickBooks. We moved to Sage. And so, we can just keep going if we want. Like, what's the travel one? What's this one? But what I think is interesting is that you're looking at probably 7 or 8 various components that are your major tech stack that you're trying to integrate them together. I would say it's not, and also a vendor is a procurement, so platform, it's rolled that out. There's a couple other platforms that can also do that. And so that's very early visibility to get, not that I'm doing a shameless plug, I can also mention some of the competitors that do that. Ramp just did an intake to procure, but Ramp is actually trying to, they started where Brex is and they've moved towards like more of a finance suite and sort of rolled out various components. And I think that is a major opportunity for that in this market where like software companies haven't really gone and built a great suite that does everything in an integrated fashion. So you can just, what I would love to have is a dashboard every day or every morning that shows me where all my cash balance is, particularly, thinking about my global days back at Vistaprint or Cimpress. That's really what you need, right?
Yours was a shameless plug, mine was a leading question.
Well, I just want to thank Katerina and Gerard for putting together this amazing panel, and to our panelists for a really interesting and insightful conversation. Thank you all.